Welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical stock research on over 5,000 stocks and ETFs. I look over there, I see we're at 5,782, so we're closing in on that 6,000 mark. With me today is David Blake, CMT, here to discuss last week's market and what we should look for as we head into this week. David, how are you doing today?
I'm doing well, thank you.
Great, let's jump right in.
Okay, well, last week we had another down week. The Dow was down for a second straight week. Nasdaq and S&P 500 were coming off of a modestly higher week the week before, but everything was down last week, especially because of some problems with Thursday and Friday. But causing that sell-off were basically more AI jitters, and then we had some CapEx worries that slammed kind of the big cap technology and Mag 7 stocks. And also we had a big pullback in the Philadelphia Semiconductor Index, which we've talked about several times. It actually was down, I think, 9.5 or 10% last week, just on that period. But we also fell into a bear market. It was down 20.2% at the close on Friday. So that's technically a bear market. Of course, then it's still up something like 60% for the year. So how you want to look at that is, whether you're long-term or short-term. Anyway, we still are seeing this rotation into the cyclical sectors. The defensive and cyclical sectors, actually 5 to 11 sectors were higher despite everything being down. And that's a plus because the sectors that were up, there was energy, of course, because of higher oil prices, but also REITs, the financial and the consumer staples also outperformed. The yields moved up during the week. We actually fell on Monday, I think, where the yields actually hit an 18-month high, and the 10-year Treasury landed about at 4.617 at the end of the period at 4.55. So again, we're near an 18-month high. As I said, crude oil prices were up pretty significantly last week because of the renewed bombings going on. And we're seeing that today again. And that's, it's going to weigh on equities, especially if we get up here in the low 80s to mid 80s. That's inflationary. And we'll have to see. I know this morning they were talking the national gas prices are once again over $4. So we'll have to kind of keep an eye on that. Now, we did get a surprise midweek because we had the CPI and the PPI both came in lower than expected. And in fact, the CPI was down 0.4% and the June PPI was down 0.3%. That's the headline numbers. The core numbers were flat, and I think one of them was up 0.2% or something like that. So that was a little bit of a surprise, and the yields were able to inch lower on that as inflation worries kind of took the back seat just for a little bit. But with the oil going up, that's going to be a bit of a problem again as they're still fighting over the Strait of Hormuz, and traffic through there definitely has slacked off quite a bit this week. Okay, Tuesday, Wednesday, we saw the Dow eke out a small gain despite IBM coming in, and it talked about they pre-released weaker than expected revenues, citing slower growth in their software and their infrastructure businesses. The stock fell almost 26%. That was the biggest drop in IBM going all the way back to 1987, and maybe even longer than that. Surprisingly, with a drop like that, the Dow was able to squeak out a small gain. That, again, was rotation more out of the tech and into the more cyclical sector. So that was good. Okay, we also had record-setting earnings come in from the money center banks. That includes Goldman Sachs and Bank of America, Wells Fargo, Citigroup, JP Morgan. They all beat handily their estimates. They think things look good out there. The economy looks strong and the banks are performing like that. But a lot of the earnings were due to trading revenues. And that's why at the end of the week, the big banks traded mixed. They didn't come in, report, and then just take off. So that was something to watch. I think they'll still be fine, but a lot of that revenue came in from trading volumes. Now, as the week ended up on Thursday and Friday, we had a pretty good sell-off. And that part of that was because of the Chinese startup Moonshot. They released their new AI model, which is apparently very competitive with Claude and OpenAI. And that caused quite a chip sell-off. And just like, remember last year, we had the DeepSeek sell-off where they came out and said, we have this AI model that's dirt cheap. With all these companies spending all that money on CapEx, we can do it much cheaper, which didn't really pan out. But I think we'll also see how these companies fare with this moonshot. I think they're looking at it with a grain of salt. Yesterday, I think the SOX was actually up a little bit, had a little bit of a bounce. And today, the SOX is up again 5%. So we're seeing a lot of buying coming back in there. They did get a little bit oversold after being down 20%. I think if you're a long-term holder, maybe you use the sell-off to maybe nibble away and you don't jump in and buy everything because we're still going into a weak period of the market, but maybe you start to nibble away at some of the ones that you like, maybe the Microns or NVIDIAs and the Marvell or something like that, that have the AI related stuff. Okay, so now for the technical condition of the market, it's still mixed. Let me run over here to the charts for a second. I want to put up the SPY, which is the S&P 500. As you know, I've been talking about this triangle pattern that's been forming. Let me see if I can bring this a little bit closer. A triangle pattern can be a continuation pattern, or it can also represent something where you have a breakout to the upside or the downside, depending if all of a sudden you break out of this pattern and head up. So when I talk about the triangles, here's an example of this. Since you come down here, the last week, you draw one here, and then you also draw another trend line up this way coming off the bottom. And then we did have that one day it really fell out of bed. But you have this, and as I said, normally I thought we were going to get a break. I think this was previous Friday or Monday. Looked like we were going to break out to the upside. You had the AD lines were positive, and it looked like it's going to resolve itself to the upside. But then it didn't go anywhere. And then we ended up coming back down. Yesterday, we were actually a little bit below it. And today we're kind of getting back up in there. But what it looks like to me is you're taking this into almost like a trading range. Okay. And the daily comment yesterday, you want to kind of draw this in there. The S&P can come down here and still be fairly healthy. Let's go over here to the Nasdaq ETF. Again, here's the same thing going on. This is actually a more defined triangle. Here you can come up here like this. And there, now this one has broken out. And even today, it's coming back up into it, but it is kind of finding resistance at the 21-day moving average. I think the NASDAQ today is up about another 300 points. NDX is also up. But if you get rid of the triangle, now you can draw in these two lines. And again, this triangle pattern did not resolve itself up or down. It kind of did on the downside. And now today we're bouncing back up into it. And so it hasn't resolved itself up or down, and that's causing a trading range. And the NDX, the NASDAQ 100, is also doing the same thing. So what you want to watch is this low over here and this low here. If we break below that, you don't have much resistance or support going all the way back to somewhere right around in here, back where we were towards April, or maybe even over here probably. You might get a sell-off down to that. That would be maybe the May, sometime in May lows. So kind of keep an eye on that, because to me, with all the stuff that's going on with the yields kind of going up and down, the escalating tensions here in the Middle East, I think the equities climb a wall of worry, but I think we have a little bit more to worry about than just a wall of worry here. And I think we're going to have to watch to see how this plays out. And again, if we see the NASDAQ especially break below this support level from the lows back here, it's going to be a little bit of a problem. Okay, now, like I said, it's kind of mixed. We also are getting conflicting signals in the technicals, and that is with the Dow Jones or the NYSE, is it's still bumping up against close to 53,000 last week. Let me see, 52,924. So it was bumping up against that for a little bit, but it's pulled back almost to where we went to a bearish position before. But at the same time, you have the NYSE making a new high on the AD line. And we consider that a leading indicator of market direction. In other words, if most stocks are under accumulation, that's a good sign that we're going to break higher. And last week, we had the NYSE advanced decline line actually make several new highs during the week, which is an indication that we're going higher. Now, again, that's confirming that rotation into cyclical stocks, because the NYSE has more of that going on. Whereas the NASDAQ, which is a tech-heavy index, the AD line actually lost almost 3,000 units. So it's been dropping for like 3 weeks in a row. In that case, we talk about it being a leading indicator. That's, again, confirming that the rotation out of technology stocks is occurring, and you need to be aware of that type of thing. We also saw in some of the breadth indicators, new highs and new lows. Now, I haven't been impressed with the NYSE new highs. They really haven't done much at all. They stay around anywhere from 100 to about 150 on a daily basis, for new highs, and the new lows stay anywhere, 30, 40, something like that. Now, part of that is because you had this rotation of cyclical. You have a lot of stocks in the NYSE and the Dow that are coming off that haven't done a lot this year. They're up 5 to 6%, whereas the index is up maybe 8 or 9%. So that's one of the reasons why I always say it's a little bit anemic, the number of new highs. And we want to see that expand if we're going to go higher, if it continues to contract. And yesterday it did contract. Actually, yesterday we only had 50 new highs in the NYSE and 48 new lows. It was almost even. But on the Nasdaq, whereas it was just barely kind of squeaking out new highs, well, last week we had 4 days where the new lows outnumbered the new highs. And you actually had, on the weekly basis, more new lows and new highs. That was the first time in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 weeks since the new lows outnumbered the new highs. So again, a mixed signals that you're getting from the two different indexes. And again, that to me is confirmation of the rotation out of tech and into more cyclical areas. In fact, yesterday with Nasdaq, you had 64 new highs, but you had 232 new lows. Okay, so that's things that you pay attention because breadth is kind of giving you, foreshadowing what the market might do. Okay, one other thing I want to talk about real quick is the sentiment. We're almost getting overly bullish again. You had the retail bulls jump to 44.9%. That's according to the AAI, the American Association of Individual Investors, and that's the most since the end of April. And then you had the percentage of bearish retail investors. It fell for a third week. In fact, it was down to 32.9. It was up to 42.3 just a few weeks ago. And then you also had the active investment managers. They went from 83% all the way back up to 95.6%. So they were jumping in. That's basically all in. They're not going on margin yet, but that's a signal that if they're all in, the reason that can start to be a contrarian indicator is because if they're all in, who's going to continue buying in big volumes if they're already buying? So that's why it's considered a contrarian indicator. If everybody's on one side of the trade, that's not good. And then you had the percentage of bearish investment advisors fall to 16.7. That's the fewest bears since mid-March. I think that was when the first bombings first started, I think, over in Iran. So again, you're getting a lot of mixed signals, which makes it a little bit hard to project what's going to happen. But as long as we stay in this trading range, I mean, the market can work its way through. And if we can just go into a sideways resolution here until things get a little bit stronger, then you're going to be fine. But the MarketEdge CTI shows that we're going to have several cycles begin to bottom here over the next couple of weeks. It's got a pretty historical positive record. So I think we're going to be experiencing some more weakness in this market rather than breaking out the new highs. So this week, we're going to get some earnings from Alphabet. We're also going to see Tesla. They're going to be the first of the Magnificent Seven stocks to report earnings. So we'll have to kind of watch that. Alphabet was actually one of only two of the Mag 7 stocks that were lower last week. They've had some good wins, but they've also had a couple losses where they've had some key personnel move to other firms from their AI department. So that's something to watch. Then on Thursday, we have our jobless claims. They're looking for 215 initial jobless claims, up from 208. And then finally, I think we get, we get the June new home sales coming out on Friday. So there's not a lot of economic data coming out this week. So I don't think you need to worry about things moving the market on economic data. But then the following week, things are going to pick up again. That'll be the last of July. And we're going to get, I think on Tuesday, we get the PCE. That's the Fed's preferred gauge for inflation. It also happens to be the day that the FOMC meeting falls. That's the day it begins. So they're going to have up-to-date data for that. And then they'll make their announcement on interest rates on Wednesday. So that's something to consider. Then we also get the GPI and a couple other big announcements on economic data. So next week will be more of where all the action is. Now, before that CPI came out and PPI came out lower midweek here, we were looking at about a 45% probability of a rate hike in July. After that CPI stuff came out, it actually fell down to about 10%. So I think we're going to still see things remain the same. Part of that also is despite the fact that we're seeing oil prices go up, they could announce that they're back in the talks tomorrow and we could see oil prices come back down a little bit. But if we stay up here in the mid 80s to maybe even start pushing 90, that's going to be a problem for the equity market. And I think I'm not a big buyer in here, if that makes any sense to you. But I'm kind of waiting for things to settle out a little bit. I might look if something happens and we break out to the upside here from the previous highs. Okay, but I'm just not so sure that's going to happen yet. And I'm a little bit cautious and not real anxious to buy or sell as the market's moving sideways.
Great. Thank you so much, David. Yes, we'll keep an eye on those cycles to see as they bottom out, looking for buying opportunities there. If you have questions for David or anyone else on the MarketEdge team, please feel free to reach out by sending us a message to support@marketedge.com or drop a comment if you're watching on YouTube. We love to hear from you guys. That's it for today. Please give us a like and subscribe if you haven't already. It really helps us out. All right. Thanks, David. We'll catch you next week.